And Kevin Simpson, Capital Wealth Planning CIO. Kevin, we got a mega or meta retail sales number today, kind of blowing away a lot of expectations. There have been a lot of people who've kind of either been calling for a recession or the imminent collapse of the consumer. I understand the case. Consumer debt is soaring and interest rates are going up. Bad combo. Did you take comfort in that retail sales number today that a soft landing is either possible or probable?
Well, I always look at the retail sales and the CPI and all these things as a true measure of inflation. Are we out there spending or aren't we as a consumer? And in your question, you put the fear into me when you think about credit card spending, because we're at over $1 trillion in consumer debt, which is the highest it's ever been. But when you combine that with a rising interest rate environment, it makes me very cautious. So you talk about a soft landing, and we all hope for that. And now we're hearing about a new term, which is the no landing. And certainly it's possible. And it's far more possible than I thought it could ever be if we were having this conversation 2 months ago, say at 5 in the morning by chance. But the labor market has made it so much more palatable for a soft landing. I mean, the resilience in this labor market, the resilience in this consumer, the resilience in so many aspects of the economy are a very positive sign. And I can see that bullish sentiment making a case. It's not my base case, but it's certainly much more of a probability than, like I said, we would have anticipated 2 months ago. I still think the Fed has to continue to raise rates. I think they're going to raise rates until they can compress this economy. They need inflation to come down faster than growth is coming down. And so far, that hasn't happened. So it kind of, in my opinion, it still makes the hard landing, the economic compression, or even a mild recession a more likely scenario. But things aren't horrible. It's not dire.
I brought up that credit card stat at a dinner because that's what I do. That's why people don't have dinner with me anymore. And we were talking about higher rates and sort of the monthly payments. And then somebody, I can't remember who it was, one of my friends looked me in the eye and said, "What if people just don't pay it back?" And I didn't have an answer for that. And I thought, we're all worried about consumer debt, and a lot of people are just mad at the credit card companies. What if they just don't pay it back and they just keep spending, which theoretically could happen, and whatever you think about it, keep the economy going? I know it's a weird thesis, but I didn't have an answer for it, which frustrates me.
We had 2008, it happened, didn't it?
Yeah. I think that's where it's coming from. And we're seeing it now with other types of debt as well. And there's a lot of sort of anti-bank sentiment still out there, whether you agree with that or not. But if we're using the consumer debt level as some sort of doom thesis for the economy, one wonders if that will actually be the case, or people just keep charging, keep flying, keep going to restaurants, and keep things afloat for a while.
Well, it can't be a doom thesis because of the labor market having the resiliency and the increase in wages that we've seen. So for now, you can raise rates, you can raise prices, you can do anything you want, and the consumer clearly is still spending. And if the eyeball test is anything, it seems to me that that's still the case. So I would hope that the flush employed consumer who's spending or stretching a little bit in consumer debt will still want to keep their credit score in good shape, still keep the economy moving forward, and will still make at least those minimum payments.
I made carry this consumer argument with Kevin on the macro. You like CarMax, and I'm thinking this is an unusual pick. The biggest used car chain when rates are going up, although, by the way, used car prices have come down a little bit, but they're still insane.
Yeah, they're still pretty high. CarMax is an interesting case. We've been watching the stock for a couple of years, and it had an enormous run up during the pandemic, and then it really had a very difficult year last year. I mean, it fell over 60%. The company is in much better financial shape than its competitors, Carvana and CarGurus. What they've done is invest a lot in their online presence. They both have physical stores or car lots, and they're mostly on the East Coast, and there's a lot of room for them to expand. But they also have a big online presence, so you don't have to pick your car online and have it delivered to you, and then you say, "Gosh, I don't really like it." You go to the lot and you try it, and they have a huge selection. And I think they're very transparent in the way that they price their cars and the descriptions of their cars. We think that what they've done is make the right investments at the right time, and expansion and the online application. And they're going to be way ahead of their competitors because they've made this investment. The stock is earning. They have a free cash flow, and we believe that it's very undervalued at this price, currently. So we bought it at a good price, and it's been reacting right.
Well, looking at the stock prices of Carvana and Vroom, I guess the novelty of actually sitting in a car you're going to spend $50. You don't want to sit there and have it smell like Jerry Seinfeld's Sob. Well, they couldn't get the smell out. They didn't know what it was, like a raccoon died under the seat. Kerry, Kevin, appreciate it. Good discussion. Have a good night.